And here's the part 2 for chapter 10 for our Monday class. And we were just talking about initial public offerings. This is when we actually sell shares to the public. Now, corporation doesn't have to be a public corporation. They don't have to sell shares to the public, just like you and your friends got together and had 4 shares of the house. They could still have shares and be a private corporation. And so we have some very large companies like Cargill or Mars Candy that is a privately held corporation. We're primarily going to be focused on publicly held companies. They're regulated by the Securities and Exchange Commission, and that's where we're focusing our energies in terms of understanding the accounting for issuing these shares. That's where it's all under GAAP. This is Walmart and Microsoft and Intel, for example. We've talked about these in the past, so while this is on the slide, I'm going to go through this pretty quickly. Some of the advantages of being a publicly traded corporation: we have limited liability as an individual owner of the company. I have a share of Intel Corporation, but Intel can't come back and get more money out of me. If they are sued, they have to address that lawsuit. They can't come back to me as the owner of the company. And we can raise a lot of capital in this arrangement, and I can transfer ownership. I could sell my share of Intel to somebody else and instead buy a share of Apple Corporation. It is a transferable ownership. Some disadvantages that we've talked about in the past is about additional taxes in terms of when we pay dividends, we do our net income. It is after we have paid our taxes that we distribute optionally. We can optionally distribute dividends to our shareholders. When our shareholders receive those dividends, they are taxable to them as well. Sometimes this is double taxation. In the current tax environment, we have very low taxes to corporations, and there's exemptions for a lot of our dividends. So it's not so much of an issue right now, but it can be. And there's significantly more paperwork involved here. If I'm a sole proprietor, the paperwork that's required from a filing standpoint is pretty small. If I am a publicly traded corporation, there is a lot of paperwork, including the initial filing paperwork. So just as check-in, what is the primary advantage of forming a corporation? It's not about reducing your taxes. It's not about increasing the personal liability of the owners. It is about the ability to raise capital and transfer ownership in this list. There's not that there are fewer state and federal reporting requirements. There are more federal and state reporting requirements. All right, so let's talk about actually what this corporation looks like. We're going to file articles of incorporation. It's a big legal document. Many companies are actually incorporated in the state of Delaware. Just like a little trivia here for you, because Delaware has lenient filing laws. So as part of our articles, we'll say, hey, there's a certain amount of shares that can be issued for this corporation. Let's say I'm going to say in this particular example, the total amount that could be issued is up to 100 million shares. Now, I'm going to try to identify more than I think I actually want to issue in the initial public offering, because maybe I'll want to issue some shares later as the company continues to grow. So we have what's called authorized stock. It's part of our articles of incorporation. Either the shares have not been issued, they're unissued, or they've been issued and they're still out with our shareholders, or we have repurchased them. That's that treasury stock terminology. So here I have, in this case, it's about half and half. About half of the shares I have not issued yet. About half of them I've issued. And here I've purchased some back from my initial public offering or from my additional share offerings, seasoned offerings. And what I own that I purchased back from my shareholders, that's called treasury stocks. We're going to work with this. So here we go. Authorized, that's just all the shares that are available to sell. That's the issued and the unissued ones. What's been issued are the shares that we've actually sold. The ones that are outstanding that are still out in the market. and the ones that we have repurchased from the market. Not everybody has treasury shares, but a lot of companies do have some. We'll talk about why. Their outstanding shares, those are they're still held by our investors, and treasury shares have been issued and repurchased by our company. All right, now we have to talk about par value. I'm so sorry. Let's talk about what this term par value, what that means when we talk about stocks. One, this is a historical concept. So if we go back to the Great Depression, there were people who were walking around the country selling stocks that really had no value. Like, here we walk up to your farm and you're like, hey, you know, everybody in New York City is getting rich. Would you like to get rich too? They're all buying stock. Would you like some of this stock? And they, you know, I deliver this beautiful piece of paper. It's like, this is the ownership of some, you know, company in the East Coast that's going to make you a lot of money. We called these selling pieces of the blue sky. And so there were something called blue sky laws that were enacted as a result of people selling things that didn't really have any value. And so as part of that concept, historically, you know, we're talking about the industrial age here, they established this concept of par value. So if I sold a share of stock, I'd have to put on the stock certificate that you were buying, you know, 1/100th of the company, and the assets in that company, like the equipment in that company, was worth, you know, however many dollars, and so you're buying 1/100th of that equipment. That's what par value was. It was part of the value of the equipment. In our current world, like, if we're talking about Google or Apple, it really doesn't have any meaning. And so par value no longer means the same thing that it used to do. It used to mean it is just the historical concept. Some states don't require our companies to have par value, and some states where we're incorporated do require us to have something called par value. Most companies now, if you look at their stock, they're like, okay, if I have to have par value, here it is. It's a cent, or it's a half a cent, or it's 2 cents. It's some very nominal amount, but it messes up our accounting. So you just need to know it's out there. All right. The legal capital is the per share of stock that's assigned when the corporation is first established, right? The par value has no relationship to the market value of the common stock. And I think the thing to do at this point is to just go out and look at a couple of these examples. So here I am. I'm at Home Depot, right? I've gone out to the Edgar database, and I'm looking at our balance sheet. And so a lot of this we're familiar with. Here's our assets and our liabilities. And now I'm in the shareholders' equity section. Okay, so here's Home Depot. The stock has a par value of 5 cents. 5 cents. So we'll see that they have, and these are probably in millions, 10 million shares that have been authorized. And then we have about 17 million that have been issued, right? These are outstanding currently. So we're going to take the par value, and when we issue it, we'll multiply it by what we've sold, and that is just the par value. Common stock. That's what we put in the common stock category. It's just the par value. We issued it for more than 5 cents. When we sold it in the market, you know, when we were originally issuing the stock, maybe it was $10, right? 5 cents of it shows up here as par value, and the other $9.95 shows up as paid in capital. So when we're evaluating how much money our shareholders gave us, we are going to add these two numbers together, this crazy par value thing plus the paid in capital. That's how much we issued the stock for. Here's our retained earnings. We're not going to spend time in this class about other comprehensive gains or losses. You'll see that in your intermediate accounting classes. And here's my treasury stocks. I purchased back, you know, some shares here, and so this has a negative equity. Treasury shares are a contra shareholders' equity account. So we'll go here and look at the statement of stockholders' equity. Here we go. We'll see here's our common stock, and here's the paid in capital. That's the one that I really want to spend time looking at add these together. That's that common stock paid in capital we've been talking about. Here's our retained earnings. We're going to add the net earnings. We'll subtract out any dividends, and then we get the balance here. Again, we're not going to talk about this section. It's very small, relatively speaking. And here's my treasury stock. And then I bought some more treasury stock. Here's my contra equity account. Let me just look really quickly here. This is looking at, this is at Apple. Apple's a little more complicated. You'll see that here's my common stock issued. Here's my beginning balances, common stock issued. Here's the ending balances in my paid-in capital. Here in my paid-in capital account. The retained earnings, I'm going to add net income. My point here in talking just at a high level about Apple is that there are more categories than we are dealing with in this introductory class. Here, we'll just look at Apple here. Am I looking at Apple? Yes, we're looking at Apple in the shareholders equity section here. Here's the common stock and additional paid-in capital. There's their par value, 0.00001 cents. Here's how many shares are authorized, 50 million. We have issued almost 17 million that are issued and outstanding. Okay, this gives you an idea of what this looks like. How am I doing for time? Oh, not that great. All right, so let's do the accounting for it. Yay! Here's Canadian Falcon. They're going to issue 1,000 shares of no par common stock. This is what we have been doing so far. This is exactly the way that we've been doing it so far. And then we're going to add this issuing common stock with a par value. So like we've done in the past, if we've issued no par stock, here we have common stock with a credit for $30,000 and we got cash of $30,000. Now, if they have a par value, we're still issuing this at $30 a share. We're still getting cash of $30,000. The only thing that has changed is that the way we account for this par value is the common stock account has that $10, that 1 cent times 1,000 shares. And then the second account is called additional paid-in capital, the amount that has been paid in above the par value. I can't fix why this, I just can tell you what it is. Let's look at this example. Here's Company A. They issued 20,000 shares of a $5 par common stock, and they issued it at $12.50 per share. The entry to record the issue would include which of the following? So, would they debit cash of $100,000? Here's 20,000 shares. They're issuing it at $12.50 per share. They're not issuing at $5, so A is not right. Would they credit common stock of $250,000? Nah, they're going to do the common stock at $200,000 times 5. That's what common stock's going to be issued at, so that's not right. They're going to credit additional paid-in capital of $150,000 or $250,000. Here's the additional paid-in capital of $150,000. It's the amount above the par value. So it's $7.50 above par value times the 20,000 shares. And we're going to credit that to additional paid-in capital. Okay, so that's where I'm going to stop for this, and we'll pick up our discussion starting with preferred shares on Wednesday. Talk to you soon. Bye.